Good evening, everyone, and welcome to Arcstone Research. And for those of you who haven't read about it or seen the messages circulating, so we are rebranding at the moment from Bullish FX. We are now going to be called Arcstone Institute, and under Arcstone Institute, we've got the research division, we've got the intelligence division, and then we've got the academy, which is continuing the mentorship part of Bullish FX. And then we also have Arcstone Advisory, and then later on I'm going to be introducing to you to Arcstone Capital and also asset management. Right. In regards to today's business, I want us to discuss what could be one of the more important macro developments for gold in the coming weeks. Right. So the title of today's analysis is the employment shock, why gold may be entering a more favorable macro regime. Right. The reason why I'm focusing on this is simple. The latest US employment report was significantly weaker than what the market expected, and by now everyone has seen the report that came out on Friday. Right. The US economy unexpectedly lost like 23,000 jobs in July, compared with expectations for an increase of approximately 85,000, right? And more importantly, June's employment figure was also revised lower by another 37,000 jobs. That is key, right? This isn't simply about 1 week headline. We're beginning to see evidence that the US labor market may be losing momentum, and that has significant implications for the Federal Reserve. It has got implications for the interest rate market, for the Treasury yields, the US dollar, and ultimately gold. Right. So I'm just going to go to the calendar quickly for those who haven't gone through their data, but as a forex trader, I'm pretty sure you know already what happened on Friday. So we're looking at the 7th, right? And we can see the non-farm payrolls for July. Forecast was 85,000, but the economy lost 23,000 jobs, right? Unemployment rate, which is also key, dropped from 4.2 to 4.1. We're going to touch on it later on, right? So let's start with the employment data, right? The market was expecting 85,000 jobs, right? Instead, payrolls contracted by 23,000, right? That's a substantial miss, right? But what I find even more important is the revision to the previous month. I'm now talking about this one here. You see the 20,000K, right? I'm just going to open the payrolls report so that you really grasp what I'm trying to implement. This 20,000K was revised from 57,000. You can clearly see there. The moment you just move your mouse at it, you can see revised from 57,000, meaning 37 jobs. June numbers was revised down 37,000 jobs, right? So when we look beyond the headline, we are seeing a broader deterioration in employment momentum, right? Now, the employment rate, the one I just touched on, this one here. the unemployment rate actually came in at 4.1%, which was below the 4.2% expectation. At first glance, you might look at that number and say, well, unemployment is lower, so perhaps the labor market isn't actually deteriorating, right? But that's not the case. We need to look beneath that headline. The unemployment rate is only one component of the labor market picture. The payroll data and revisions are telling us that employment growth is weakening in the United States. And for the Federal Reserve, that matters, you see, because the Fed has two major considerations. They've got two mandates. I'm pretty sure everyone who watched Powell's press conferences, his first statement was like price stability and employment. If employment begins deteriorating meaningfully, the policy equation is going to change, right? What does that mean for the Fed? This brings us to the most important part of today's discussion, the Federal Reserve, right? So in terms of reports, guys, before I continue, you get your reports from a lot of online sources. I also use the Federal Reserve Bank of St. Louis for the reports. I also use the Fed's website, federalreserve.gov. This one mainly for the press conferences and the FOMC meeting minutes, right? And then we've got investing.com, right? This is where we get most of our news releases, right? So the Federal Reserve, the question isn't simply, was NFP weak, right? The better question is, does this report change the Fed's policy reaction function? And I believe it potentially does. A weaker labor market reduces the agency for the Federal Reserve to maintain an increasingly restrictive policy stance. If employment continues to deteriorate, right, the Fed has less justification for additional tightening. Now, I'm not saying the Fed is automatically going to cut rates at the next meeting. The next meeting is going to be sometime in September. Yes, 15 and 16 September. That's our next Fed meeting. And the fact that it's got a asterisk, that meeting is associated with a summary of economic projections. So we have had two of those this year, the March meeting and the June meeting. So the next one is going to be September, right? That's an important distinction, right? Inflation remains critical. The Fed cannot simply ignore inflation because employment is weakened. But what has changed now is the balance of risks. Previously, the market could focus heavily on inflation and the possibility of rates remaining higher for long. Now we have another variable entering the equation, which is the labor market deterioration, right? And that introduces the possibility that future Fed decisions become increasingly focused on supporting economic activity. Now, let's connect this to the financial markets, right? This is where things become interesting. The transmission mechanism we are watching right now at Arcstone Intelligence is that a weak labor market results in less pressure for the Fed tightening, which in turn affects the interest rates expectations, right? If that is the case, we'll be anticipating lower interest rate expectations, which in turn results in lower treasury yields, right? Just gonna go to trading view quickly. Talking about those three there on top, the 5-year, 10-year, and the 30-year, right? So if we anticipate lower treasury yields, what do we anticipate DXY to do? A weaker US dollar. A weaker US dollar in turn results in a strong precious metal, as in gold, right? This is the macro chain that you have to look at things. I want you to understand why each step matters. If the market begins pricing a lower path for US interest rates, treasury yields can come under pressure. If US yields decline relative to other markets, the dollar's yield advantage can weaken. And when the dollar weakens, gold benefits, right? Gold is going to increase in value. But there's another important component, which is opportunity costs, right? Why lower rates matter more for gold? Gold is different from an interest-bearing asset. Gold doesn't pay you a coupon. It doesn't pay you interest. So when interest rates are high, investors have a great incentive to hold assets that generate yield. But when interest rates and bond yields decline, the opportunity costs of holding gold decreases. And this is why the relationship between gold and real yields is so important. If yields begin moving lower, while expectations for monetary policy become more accommodative, gold becomes relatively more attractive. We're going to start seeing the resumption of the uptrend towards 5,000. So we potentially have two forces working in gold's favor. Number one, lower yields, and number two, a weaker dollar, right? Now, before I continue, okay, number one, yields, number two, dollar, right? That combination can create favorable macro environment for the precious metal, right? Before I continue to the next variable, I want you to look at the long-term rates, the yields, right? Look at the current month on the 5-year. Then we go to the 10-year. Then we look at the 30-year, right? Now I'm going to go on to the weekly chart, for example. Then weekly chart, then also weekly chart here, right? Everything looks in tandem, right? We're talking of the weekly chart. But if you look closer, right? If you look at the week of July the 20th on the 10-year, right? This is the 10-year yield, right? We actually traded above, potentially a stop hunt, right? And then if we look at the 30-year, right, we did the same, traded above. And if you look at the 5-year, we did not, right? You can see the 5-year did not trade above July 20 highs. The week of July 20 highs, we did not trade above that on the 5-year yield. That's SMT on a higher time frame, folks. Take note. That's SMT on a higher time frame. These are the type of price action that you start seeing when the trend is about to change. SMT on the long-term rates, right? Thought I should highlight that for you before I continue. Now, the next variable in this whole employment shock is energy prices, right? Declining energy prices can contribute to lower headline inflation pressure, right? If you look at UK oil, if you look at US oil, Brent crude, you can see how energy prices are declining massively, right? 3 weeks ago, we were talking of $100 a barrel. Now we are way towards $82 a barrel, and prices are currently heading towards $70 a barrel, right? If we go to the calendar, right? If we go to the calendar and we look at next week, no, not next week, this week, we've already started. We've got CPI coming in on Wednesday, sorry. We've got CPI here, right? Forecast 3.4. Previous it was 3.5. As a market expectations suggesting inflation to drop, right? So declining energy prices can contribute to lower headline inflation, right? And if energy prices remain contained, that potentially gives the Federal Reserve more room to respond to weakening economic activity. Think about the policy equation, right? If employment is weakening and inflation pressure is moderating, the Fed has considerably more flexibility. That's the environment markets would interpret as increasingly dovish, right? And that is potentially supportive for both lower yields and gold. But there's a catch. We shouldn't take 1 week employment report, the one we saw on Friday, and immediately conclude that gold can only go higher. Markets don't work like that. The next major variable is inflation, and we've got the report coming in on Wednesday, 2:30. We've got the inflation report, and then on Thursday we've got producer price index. These are all major inflation reports that the Fed look at, right? If we see employment deteriorating but inflation remaining stubbornly elevated, the Fed may still be reluctant to ease policy, right? And if the market starts pricing higher rates again, we could see the equation turn to higher yields, a stronger dollar, then pressure on gold. So the employment report gives us the initial macro direction, but inflation data will help determine whether that direction can persist. That's why at Arcstone Research, we are looking at NFP in isolation. We are looking at the relationship between, we're not looking at NFP in isolation. We're looking at the relationship between employment, inflation, rates, yields, dollar liquidity, and gold, right? So what am I watching in gold? From a market perspective, right? From a market perspective, I'm watching 3 things very closely. Number 1, the US Treasury yields 1, 2, and 3. Precisely. The 5-year, the 10-year, and the 30-year. If yields continue moving lower, that would reinforce the gold thesis of moving higher, all right? And we already have SMT on a higher time frame on the yields. The second is dollar index. If dollar begins establishing a sustained bearish structure, that would provide another confirmation, right? I'm gonna go to the monthly chart quickly. You can clearly see where dollar has found resistance on the monthly chart. It's right here, right? and also on this breaker here. So we clearly have a structure where the market is moving to the downside. If you look at the structure of the last 3 months on dollar, it's similar to the structure on the 5-year, not the 5-year. Okay, the 5-year, but on the weekly chart. We didn't trade above June highs on DXY. And the third is gold on price structure. The macro environment can tell us why gold should move higher. You can clearly see since the opening of this candle, market has established a strong uptrend, right? If we go on to the next lower time frame, say the weekly chart, you can see this consolidation which we had here. Market returned to that level, consolidated, and boom, a big expansion, right, to the upside. But price action tells us when the market is actually accepting that narrative. That's where technical structure becomes important. We don't want to chase the headline. We want to see the macro thesis and macro structure align. Now, the macro view at Arcstone, our current assessment is that the latest employment report has created a more favorable macro environment for gold. The labor market is showing signs of weakness. That reduces pressure on the Federal Reserve to be more restrictive. If rate expectations decline, yields can move lower. Lower yields reduce the opportunity costs for holding gold. And if the dollar weakens simultaneously, gold receives another potential tailwind to move to the upside. So our current framework is this: US dollar increasingly vulnerable, right? Treasury yields, downside risk is quite high at the moment. Gold, constructive macro bias, right? But confirmation remains essential. The next major piece of this puzzle is inflation, which is coming in on Wednesday, right? And Thursday with PPI. Right. So if there's one thing I want you to take away from this analysis is this: don't trade the NFP headline. Understand the macro transmission mechanism. A weak employment report by itself doesn't automatically mean gold goes higher. What matters is what the data does to Fed expectations, to Treasury yields, to the US dollar, and ultimately the opportunity cost of holding gold. Right now, that chain is becoming increasingly favorable for gold, but markets will continue to test the thesis through the incoming inflation and economic data. This is precisely why we don't simply react to individual economic releases. We build the narrative, identify the macro regime, and then wait for price to confirm. I'm Ivan, and this is Arcstone Research, Clarity, Structure, and Edge. I will see you in the next market intelligence briefing. Thank you.